You know what? You should just get used to making less money. That is exactly what Warren Buffett and Charlie Munger said at their Berkshire Hathaway meeting back in May.
I think it's gonna get tougher.
Like, does this mean that the good days are over? Is this forever? Is this permanent? Is this short term? Well, let's find out. Let's talk about that right now. Now, I actually went into this article here on Yahoo Finance. So here's what it says. It's like, asked during the Saturday's Berkshire Hathaway meeting, annual shareholders meeting about the future of value investing, Warren Buffett and Charlie Munger found themselves divided. Ever the optimist, Buffett argued the future of value investing remains strong for one key reason: the competition. Now, here's what's interesting. And I think this is an important thing to go in addition to this making less thing. He says, what gives you opportunity is other people doing dumb things. Right? That's what Buffett said. He says, during the 58 years we've been running Berkshire, I would say there's been a great increase in the number of people doing dumb things. And they do big dumb things. And the reason they do it, to some extent, is because they can get money from other people so much easier than when we started. Now, when he's saying like, well, there's so much more money, when we had all this money coming from the COVID relief and everything else, not to mention just the accessibility for everyday, I wouldn't even call it people investors, everyday average Joes, they'll throw money in different markets. Heck, you can buy crypto easily. You can go buy any kind of funds you want so easily. There's a lot of money being thrown at these portfolio managers. The problem is that now the money is so big, the party has been so nice, right? It's like what they say, the bigger the party, the bigger the hangover. We have had an amazing blast for the last really decade plus, but then the COVID thing just blew that bubble out of proportion. We were already in a bubble by 2020, and now that bubble just got crazy big. It's like that bubble you blew up, and it just got bigger than your face, and poof, and it sticks to your face and your hair and stuff. And now you're pulling out of your hair and everything else. It's that kind of bubble that we're gonna be dealing with. It's gonna be something that we're gonna have to deal with the repercussions with for a long time. And so he's saying people have done some big, dumb things, because when you have extra money, you can. And it's not your money, right? Which is different than their days when they did investing. And back in their day, when they ran uphill both ways in the snow, right? Back in their day when they did investing, there wasn't all this money being thrown out. You had to be really wise with it. But what I've noticed is with mutual fund money managers, and heck, even portfolios, you hear about things like BlackRock, and you're hearing about the different companies that are, buying up whatever, right? Some of them even bought up real estate. Even the ones that bought real estate would buy like 20% over ask price. Ridiculous amounts. And that's when there's already competing offers, but they would just automatically throw 20% over. Now, a lot of my friends that were in the real estate game loved it. They said, oh, the fact that these companies are throwing so much money at us because they have their portfolios or whatever, we'll take it, we'll make lots of money. But again, what happens after that? What happens if it doesn't appreciate another extra 20% or so? What are they gonna do with their portfolio? That means people lose money. The people that threw money at these investors, these fund managers then go and invest, now you're not making as much money anymore. So that's a problem. That's a big problem in my opinion, is that you're seeing a lot of these money managers have so much money, they can't just let it sit on the sidelines, so they gotta do something with it, so they make dumber and dumber mistakes with it. That will dry up soon. There will always be balance brought back to the force, right? And definitely these Sith Lord of money managers know what's going on, and it's gotta come back. We gotta have the Jedi come back here, and actually the financial Jedis make this really good. I was trying to make a Star Wars reference because I haven't watched a lot of Star Wars lately, but it's the truth. It's like there's a lot of dumb things happening right now, and we need to bring things back into balance, right? Now, let's get to the next part, the part about, get used to making less. Well, that was Charlie Munger, the guy that's less optimistic, right? And he's got a lot of great sound bites, because when he gives sound bites, people, get riled up sometimes. Now, he said this, and this I say quote, he says, I think value investors are going to have a harder time now that there's so many of them competing for a diminished bunch of opportunities, Munger said. So my advice to value investors is to get used to making less. And of course, Buffett quipped, says, Charlie's been telling me this the whole time. He's telling me the same thing the whole time, right? Now, let's get back to what Charlie Munger is saying here. This is Warren Buffett's partner. He's saying value investors. Now, if you're not familiar with that term, value investors mean people that buy and hold, right? It's like, and ultimately what they do, they like to buy things that are undervalued. So buy low, sell high, right? When they look at companies, they want to buy them when they're cheap, when they're a good value. Just like if you're going to try to, buy a real estate piece of property, right? You don't want to buy it overvalued, right? You want to buy it undervalued ideally, if you can do that. Buy it under the price so that you have some extra equity in that property. Same thing with stocks. Unfortunately, that's not happening as much. And what he's saying is, of course, that there's a diminished bunch of opportunities right now. There's a scarcity of opportunities. Specifically saying there's so many of them competing for these diminished bunch of opportunities. So right now he's saying there's not a lot of value in the markets. And they've said this before too. They've been saying this leading up to that, is that everything's overbought. Like really legitimately, most of the stocks you're seeing in the stock market today are over the value they should be. But because these money managers have this extra money, they're like, well, I gotta put it somewhere, I'll put it here. And so they start loading up into these stocks, driving the values up, even though there's no reason for the values to go up. This is a problem. This is a big problem because when you drive those values up, the real investors, right? The guys like the Warren Buffetts and the Charlie Mungers, and even some of the people, even those certain money managers too, not all of them, right? But some money managers that are smarter than others, they'll say, you know what? This is not a good time to buy. Maybe I'm gonna hold in cash. In fact, Berkshire Hathaway, which is one of the funds that many people rave about being one of the best performing funds they've had, they've outperformed the S&P much better than the S&P has. In fact, their average return, even says here in the article, since 1965 is 19.8%, which is, they say, double the S&P's 9.9 annual gain over that same period. That's debatable what that would actually do for you, because 9.9 is pretty dang good. But when you go back to the 60s, it's possible. So it's more than double, right? It's about double whatever the S&P's been. Well, why? Well, right now their portfolio, they have 20% of their portfolio sitting in cash or cash equivalents. They're not even investing it in companies right now. They definitely got a lot of money in companies, but they're spreading their risk pretty minimally. You know, they're trying to make sure that they don't get over leveraged. And so they're holding a lot of cash. I think one, for protection purposes, but two, because they're not finding good opportunities to buy. What does that mean for you? That means if you're a value investor, right? Which obviously you're probably not, but when you're going into mutual funds, you're assuming that the fund manager is doing value investing so that your money grows over the long haul, right? What he's saying is, guess what? Well, you should get used to making less money. Why? Because everything's overinflated. And that means it's got to come back down again. It's either got to come back into balance or it stays the same. Maybe it stays flat, but it stays flat for a very long time. Understand that there's different ways that this stock market can go. It could go up, but with it already being overvalued. I mean, Tesla is like 100 times its valuation right now. It's way overvalued just because there's hype around it. And understand this too, what they didn't say, but this is really part of it, is that there's trading platforms happening that aren't run by humans, right? Just like with the invention of AI and everything else going on, there are trading platforms buying and selling purely off of words that show up in media and announcements and things like that. They're literally buying and selling stocks based on words, that you see on Google and media and things like that, almost like spider crawling, like the web spiders they talk about, not real spiders, right? But they're going out searching for all these things to see what should they buy and sell. Well, these aren't even humans anymore. It's happening faster than humans can respond. Well, what happens when all of a sudden this party ends and we start going to the hangover, right? What happens when this bubble pops and it's into your hair? This is what they're referring to, is that the party is over. Expect things to not just go down necessarily, but things not to be returning as well. Understand, if it doesn't go down, see, the faster it goes down, the better for you, because it's not good short term, but usually the faster it goes down, it will overcorrect and then pop back up again. The worst thing that can happen to you is that it doesn't go down very fast or very much. Instead, it goes flat. And what ends up happening is that inflation keeps going up, but you're not making money. And the market just goes flat. This actually happened in the 70s. If you look at the 1970s, it didn't do much. The 2000s, a great time. I mean, we had two market dips, right? We had a dip after Y2K and a dip in the Great Recession. That's why it took people 15 years plus, depending on what they were invested in mutual fund wise, to get back to breaking even on their stocks, on their mutual fund investments. That's not where you want to be, guys. You don't want to be caught in that. What they're saying is this is a bad time right now. And so if you're looking for great returns like 8, 9, 10% plus in the stock market, it ain't gonna happen. They're saying that party is over. So in fact, I'll even end with the last quote they put in this here, which pretty much just says what I said here. It says, there's so much money now in the hands of so many smart people, all trying to outsmart one another, Munger said. It's a radically different world from the world we started in. So here's the thing, if you're a small investor, you're not gonna be able to compete with some of these guys with big money. But the truth is they're all trying to outsmart each other, and there's a lot of dumb things happening right now, like they said, that you need to be watching out for. This is probably the best time, better than ever, to control your own money, to do your own investing versus just giving your money away to somebody else, hoping that they're gonna make money, but in truth, they're just trying to figure out what to do with all that money because they don't know how to get it all out there, and they're gonna invest in things that they shouldn't be. And that only hurts you, not them. They get paid regardless. They get paid on the portfolio that you have under management. You, however, that's your life. Guys, I recommend taking control of your own finances, and I agree with them. Get used to making less if you're trying to put your money in the stock market. It's happening right now. This might be the best time for you to be able to make changes in your life today. If you guys like this, go ahead and click like on our videos here so you can see more. And by the way, if you want to see something really cool, check out this next React video where Dave Ramsey looks at Graham Stephan's portfolio and actually admits to something that you normally don't hear Dave Ramsey say. Check that out.